Aaron, what is the difference between passive and active investing?
So this is a somewhat charged and controversial topic. People have strong feelings in one direction or the other. But essentially the argument is around whether or not active decision making in terms of which equities you put into an investment portfolio has any benefit over simply buying the benchmark that your portfolio manager is measured against. The most common benchmark being the S&P 500, so we'll talk about this today. Can you beat the S&P 500 by actively picking stocks as an investment manager? And there's a strongly supported theory that you can't, that is driven around the efficiency of the stock market. Does the price discovery mechanism of the stock market work so well that as a portfolio manager, you can no longer find opportunities that haven't been discovered already and priced out of the stock market?
So, what does it mean to beat the benchmark?
So most of the time when people look at did you beat the benchmark, they're just simply looking at the investment rate of return. The S&P 500 did 20%, just to pick a number, and the investment manager did 15%. So you outperformed by 5%. But it's not as simple as that, because we have to consider it from a risk-adjusted return. Twice in the past quarter century, the S&P 500 lost 50% of its value peak to trough. So the first time was after the technology bubble of the late 1990s. Peak to trough, the stock market performed, the S&P 500 performed negative 50%. Then the financial crisis in 2008, peak to trough, 50% loss. I don't know a lot of typical wealth management clients that would be satisfied with a 50% loss on their equity portfolio in any particular year, even if there was a recovery. So investment managers know this, and so they tend to be somewhat more defensive than their benchmarks.
So, is passive investing a false sense of security?
Yeah, passive investing can be a false sense of security if you're not looking at the investment also through a lens of risk. Sometimes in economics, we look at theories from the extreme perspective to understand the breaking points of a theory. And so one of the ways I think about passive investing is the function of the stock market is price discovery, efficient allocation of capital. Imagine a world where every single participant in the stock market was passive. No one now is making decisions about stocks to purchase based on an evaluation of the merits of that investment. They're now only buying the stock simply based on its weighting in a particular index. Well, now price discovery is no longer happening by anyone. So the question I pose sometimes is, what is the breaking point? As we have more and more investment capital moving into a passive strategy, at what point does the process of price discovery break down such that now, again, there are inefficiencies in the stock market that are large enough to make active management worthwhile? And this is a theoretical exercise. It's not, I'm not an academic who's going to evaluate that from a statistical measure, but it's a worthwhile thought exercise.
And if we look back to 2025, why have active managers underperformed their benchmarks then?
So 2025 is a year where active versus passive have the debate has come to the forefront. And the reason being that most active managers have underperformed their benchmarks. It would be hard to find one that outperformed its benchmark just on a rate of return perspective. Now, let's think back to the beginning of the year when the discussion around trade barriers and tariffs and trade wars came to the forefront. Economists, analysts, investment managers clients, pretty much anyone who was commenting on the stock market was fearful. Words like depression, recession, crash were at the top of mind. So investment managers became defensive because we frankly didn't know what was going to happen. Think of it as though you're buying insurance because you're afraid of a risk, and then at the end of the year, that risk didn't become reality. It doesn't mean that the insurance didn't serve a purpose. There was no reason to be defensive. And it doesn't mean that next year you don't buy insurance because last year the insurance didn't pay. What it means is that you need to have a balanced approach between trying to outperform your benchmark versus trying to manage the risk in that investment mandate. And most investment managers in the past year, the market surprised us to the upside. That's a great win for everyone. That doesn't mean we don't be actively defensive in the future.
So then how do I choose between these two styles of investing?
Okay. So the theory is mostly focused around the most liquid markets tend to be the most well suited to passive investment management. So large cap US stocks have a lot of sort of eyeballs looking at them, a lot of smart people deciding how to evaluate those. So the efficiencies in that segment of the market tend to be quite tight. In less liquid stock market segments, there may be more opportunities for mispricing. So that could be a decision factor. It's not a binary choice, though. You can have part of your portfolio active and part of your portfolio passive. And you can switch between the two. One factor, though, to consider is that historically the argument in favor of passive investment management has been cost. Give up on the idea that you're going to outperform the benchmark and just minimize those costs. But what's happened, particularly with SMA management, is the cost of accessing actively managed portfolios has also been declining, such that the difference between active and passive investment management is starting to become not so significant that it should be a decision factor in your decision between active versus passive investment management.